The 5 financial steps to your first home in 2026. Does buying your first house feel less like an exciting new chapter and more like a financial pop quiz you didn't study for? You're drowning in a sea of acronyms: DTI, PMI, LTV, and the goal of being mortgage ready feels like it's on another planet. Every headline about climbing interest rates and impossible home prices just adds to the noise, making you wonder if you'll ever swap those rent payments for a mortgage of your own. It's enough to make anyone feel defeated and question if owning a home by 2026 is even in the cards. But what if I told you that you could knock down the 5 biggest financial hurdles with a straightforward, totally achievable game plan? What if you could trade that confusion for genuine confidence? In this video, I'm going to show you exactly how to do that, step by step. We're going to clear up the numbers, map out a plan, and put you on a direct path to buying your first home. This isn't about wishful thinking. It's about smart financial strategy. So, if you're ready to stop dreaming and start doing, you're in the right place. My name is Marvin, and over the years, as a real estate agent, I've sat across the table from aspiring homeowners who started out feeling exactly like you might be right now. A little lost, a bit intimidated, and not sure where to even start. My job is simple. I cut through the jargon and give you a straight up actionable advice that gets you from "I'd love to own a home someday, here are the keys to my new house." I'm not just an agent, but I've also been a buyer myself, and I've seen this whole process from every angle. I know the traps, I know the shortcuts, and I know what lenders really look for. The 5-step roadmap. Look, getting into your first home isn't some giant impossible leap. It's more like a financial workout plan, a series of smart, calculated steps. You wouldn't just walk into a gym and try to deadlift 500 pounds, right? You've got to build up to it. We're going to apply that same logic to your money. Today, we're going through the 5 financial workout that will whip you into prime mortgage ready shape for 2026. We'll cover everything from your credit score, ultimate gatekeeper, to what your debt to income ratio actually means for your budget. We'll map out a realistic down payment plan that doesn't involve eating ramen noodles for 2 years, and we'll shine a bright light on the sneaky hidden costs that catch so many buyers off guard. Finally, we'll get you that all-important pre-approval, the green light that says, "Let's go shopping." By the end of this, you'll have the complete roadmap. Let's get into it. Step 1, master your credit score. This is the gatekeeper. All right, let's dive into step 1, mastering your credit score. I call it the gatekeeper for a good reason. It can either swing the door to homeownership wide open or slam it shut in your face. It's the very first number a lender looks at, and it doesn't just decide if you get a loan, it determines how much that loan is going to cost you. So, what is your credit score? So, your credit score is just a 3-digit number that tells a lender how reliable you are with borrowing money. A high score says you're a safe bet, a low score screams risk, and lenders will either deny you outright or charge you a fortune in interest to cover that risk. For most conventional loans, you're generally looking at a minimum credit score of about 620 to get in the door. But here's a pro tip. The game isn't just about hitting the minimum. Some state or local programs, for instance, might require a higher score, like 660 or 680. The difference between a 620 score and a 740 credit score can be absolute staggering. A higher score gets you a much lower interest rate. So let me paint a picture for you. On a $350,000 mortgage, someone with a 760 credit score might snag a 6% interest rate, but a person with a 630 credit score could be offered 7.5 for the exact same house. That 1.5% might not sound like a big deal, but it could cost that second person an extra $400 every month over 30 years. That's over $144,000 in extra interest. That's not just a number, that's a college fund, a dream kitchen, or years of family vacation gone. That's the real price of a shaky credit score. This is why your first mission is to get that score as high as possible. Here's the action plan. First, know your number. Go to the annualcreditreport.com to get your free credit reports from all three bureaus: Equifax, Experian, and TransUnion. This is the official government-approved site, so don't get fooled by lookalikes. Scour those reports for errors, a wrong address, an account you didn't recognize, a payment you know you made on time. These mistakes can drag you down. If you find one, dispute it immediately. The Fair Credit Reporting Act is on your side, and cleaning up errors is the fastest way to see your score jump. Second, tackle the two big dogs that make up your score: payment history and credit utilization. Payment history is as simple as it sounds. Pay all your bills on time, every time. A single 30-day late payment can tank your score by up to 100 points and haunts your report for 7 years. If you're forgetful, set up automatic payments for at least the minimum amount due. This is non-negotiable. Credit utilization is the next heavyweight. This is how much of your credit you're using. If you have a $10,000 credit limit and a $5,000 balance, your utilization is 50%. Lenders want to see this under 30%, but the real sweet spot is under 10%. Your mission here is to aggressively pay down credit card balances. Start with the card that has the highest utilization percent, not necessarily the highest balance. Getting even one card below that 30% threshold can give your score a quick and satisfying boost. Finally, a quick word on what not to do for at least a year before you want to buy. Don't open a bunch of new credit cards just for the points. Don't go finance a new car or a living room set. And please do not close your old unused credit cards. Closing an old account shrinks your total available credit, which can make your utilization jump and your score drop down. Just let those old accounts hang out and boost your credit history length. Your credit score is a living, breathing number. Start now, and you'll give yourself plenty of time to build it into something lenders can't wait to see. So in step 2, it's all about conquering your debt to income ratio, your DTI. Okay, your credit's looking sharp. Now we tackle the next big beast, your debt to income ratio, or DTI. If your credit score is your report card for the past year, your DTI is a snapshot of your financial health right now. It answers the one question every lender is asking: can you actually handle a monthly mortgage payment on top of everything else you owe? Simply put, your DTI is a percentage that shows how much of your gross monthly income, that's your pay before tax, is already spoken for by debt payments. Lenders use it to see if you're financially stretched or have room to breathe. Here's the magic number you need to burn into your brain: 43%. For most mortgage lenders want your total debt payments, including your new potential mortgage, to be at or below 43% of your income. Some government-backed loans might give it a little more wiggle room, but 43% is the gold standard. So let's do the math. It's a simple 2-step process. First, add up all your monthly debt payments. This is your car loan, student loans, personal loans, and the minimum payments on your credit cards. This does not include living expenses like rent, utilities, or groceries. We're only talking about the debts that show up on your credit report. So let's imagine your monthly debts are a car payment of $400, student loan payment $300, credit card minimums $200. So this brings your total monthly debt to $900. Secondly, figure out your gross monthly income. If your annual salary is $72,000, your gross monthly income is $6,000. Now, let's see what a lender sees before the mortgage. That's your front end. DTI $900 divided by $6,000. This equals 0.15 or 15%. Not bad. But the lender cares about the back end DTI, which includes your new house payment. Let's estimate your future all-in mortgage payment, which is principal, interest, taxes, and insurance. So let's say it's $2,000. Your new total monthly debt would be $900 plus the new $2,000, which equals $2,900. Your new DTI would be $2,900 divided by $6,000, which equals 0.483 or 48.3%. And just like that, even with a stellar credit score, you're over the 43% limit and a lender would likely say no. This is the exact math that trips up so many buyers. So what's the plan? You have two levers you can pull: decrease your debt or increase your income. Pulling both is like hitting the turbo button. To crush your debt, focus on wiping out smaller loans completely. Getting rid of a small personal loan doesn't just feel good. It eliminates an entire line item from your DTI calculation. If you have a car loan with only a year left, see if you could pay it off early. Every monthly payment you erase creates more space for your mortgage. On the other side, think about boosting your income. Can you document your side hustle? Lenders usually want a 2-year history. Is it time to ask for a raise? Can a partner start contributing to the household income? Every extra dollar of consistent, provable income pushes that DTI percentage down. Your DTI isn't just some random number for the bank. It's a reality check for you. A high DTI means you're living on the financial edge. By lowering it now, you're not just getting ready for a lender. You're setting yourself up for a future where you can actually enjoy your home without being house poor. In step 3, it's all about building your down payment fund, the sprint and the marathon. All right, let's talk about the big one, the topic that gives almost every first-time buyer a case of the sweats, the down payment. It feels like this giant, impossible mountain. But the truth is, this part of the process is totally misunderstood. We're going to turn that mountain into a series of hills you can actually climb. First, let's sprint to kill a stubborn myth. You do not need to put 20% down. While 20% is great because it helps you avoid private mortgage insurance, PMI, it's not a requirement. Far from it. Many conventional loans let you put down as little as 3%, and government-backed options like FHA loans start at 3.5%. So, what's PMI? It's basically an insurance policy that protects your lender in case you can't pay your mortgage. The catch is, you pay for it every month. It can add a couple $100 to your payment, but don't let that fear of PMI stop you. For many, paying PMI for a few years is a small price to pay to get in the game and start building your own wealth instead of your landlord's. Plus, once you hit 20% equity, you can ask to have it removed. Now, for the marathon, actually saving the money. This takes a plan. First, open a dedicated high-yield savings account and name it something motivating, like Future Awesome House. This does 2 things. It separates the money so you're not tempted to spend it, and the high-yield savings part means your money actually grows a little on its own. Next, automate everything. This is the most powerful savings hack there is. Decide on a realistic amount, $100, $250, $500 from each paycheck, and set up an automatic transfer for the day after you get paid. You pay your future home fund first before you have a chance to spend money on something else. Wondering where that money will come from? Time for a budget audit. Print out your last 3 months of bank statements and get ruthless with a highlighter. Where is your cash really going? The daily lattes, the takeouts, the lunches, the 5 streaming services you don't watch. Rerouting that money to your savings isn't about deprivation. It's about making your goal a priority. But it's not just about saving. It's about getting help. Become a detective, a hunt for down payment assistance programs, DPAs. Many states and cities offer them in the form of grants, free money, or forgivable loans. For example, California has had the Dream for All program, which helps with down payment. While that specific program has had funding pauses and it's expected to reopen in 2026, it shows the kind of powerful assistance that exists. A simple Google search for your state first-time home buyer programs is the best first step you can take. Finally, Keep an ear to the ground for federal programs. While there isn't a major home buyer tax credit right now, new bills are often introduced in Congress. For example, a bill known as H.R. 3475 has been proposed that could offer significant tax credits. Nothing is guaranteed until it's signed into law, but staying informed could pay off big time. Building this fund is a test of your commitment, but by automating your savings and hunting for help, you can turn this scary number into an exciting goal. Step 4, account for the hidden costs, closing costs, and reserves. This next step is where so many buyers get blindsided. You work your tail off to save for the down payment. You're feeling great, and then bam, days before closing, you get a bill for thousands more in closing costs. Let's make sure that doesn't happen to you. Your down payment is not the only check you'll need to write. So, what are closing costs? They're a collection of fees for all the services required to finalize your mortgage and legally make you a homeowner. Think of them as a transactions admin fee. On average, you can expect closing costs to be between 2% and 5% off the home's purchase price. On a $400,000 house, that's an extra $8,000 to $20,000 in cash you need, completely separate from your down payment. So let's pull back the curtain on these fees so they don't surprise you. Lender fees. This is what the bank charges for creating the loan, including origination and underwriting fees. Appraisal fees. The lender needs a professional appraisal to confirm that the house is worth what you're paying for it. Title insurance and search. A title company makes sure the seller actually has the right to sell the house and there are no old claims on it. You buy insurance to protect you and the lender. Home inspection fee. This isn't always required, but it's non-negotiable in my book. An inspector checks for hidden problems that could cost you a fortune later. Escrow and prepaids. This is a big one. You'll have to prepay several months of property taxes and homeowner insurance into an account that the lender manages. Attorney fees. Some states require a real estate attorney to be at the closing table. The list feels long, but your action plan is simple. Save for it and negotiate. When you're building your future awesome house fund, you need to be saving for both your down payment and your closing costs. A good move is to create 2 saving goals within that account. Even better, you might not have to pay for it all. You can negotiate for the seller to pay a portion of your closing costs. This is called a seller's concession. Especially when the market isn't red hot, a seller might be happy to pay or chip in 2 or 3% to make the deal happen. This is a powerful strategy your real estate agent can help you with. Finally, there's one more pile of cash you need: reserves. Lenders do not want to see you drain your bank account to zero on closing day. They need to know you have a cushion. Most lenders want to see that you have at least 2 to 6 months worth of full mortgage payments, PITI, sitting in savings after you've paid everything else. This is your emergency fund. And for a lender, it's proof that you're a safe bet. Ignoring these costs is a rookie mistake. Plan for them and you'll walk into closing day with confidence, not panic. Step 5, get pre-approved, the green light. Okay, you've done the financial workout. You've polished your credit, tamed your DTI, built your savings, and planned for every cost. Now it's time for the step that makes it all real: getting pre-approved for a mortgage. This isn't just a good idea. In today's market, it's your golden ticket. It transforms you from a window shopper into a serious, powerful buyer. First, let's get one thing straight. A pre-qualification is not a pre-approval. A pre-qualification is a flimsy 10-minute estimate based on what you told the lender. It holds almost no weight. A pre-approval is the real deal. It's a conditional promise from a lender to loan you a specific amount of money. To get it, you have to formally apply and provide all your financial documents. So here's some of the things you'll need to provide your lender: pay stubs and W-2s, 2 years of tax returns, bank and investment statements, proof of any other debts. After providing these, an underwriter, which is a real human being, will comb through all your entire financial life. The result is a pre-approval letter that tells everyone that you're a fully vetted, ready to go buyer. In a competitive market, many sellers won't even look at an offer that doesn't have a pre-approval. So here's your action plan. Shop around. Don't just walk into your local bank branch. Rates and fees can vary widely between lenders. You need to apply for a pre-approval with at least 3 to 5 different places. Try a big national bank, a local credit union, and a mortgage broker who can shop dozens of options for you. Don't worry about hurting your credit score. As long as you submit all your mortgage applications within a short window, usually 14 to 45 days, depending on the scoring model. They'll all count as a single inquiry. To be safe, try to get it all done within 2 weeks. Comparing the official loan estimates you get from each lender is how you find the best deal and save yourself thousands. Getting pre-approved does 2 critical things. First, it gives you your real budget. No more daydreaming about mansions you can't afford. This gives you a hard price ceiling so you can search with focus. Second, it gives you massive leverage. An offer from a pre-approved buyer is infinitely stronger because it tells the seller your financing is solid and the deal is likely to close. Think of the pre-approval as your financial final exam. It confirms all your hard work and officially gives you the green light to start the fun part, finding your first home. And that's the roadmap. 5 steps. That's the game plan to take you from renter to homeowner in 2026. So let's recap quickly. First, you master your credit score. Second, you conquer your DTI ratio, your debt to income ratio, proving you can handle the payments. Third, you build that down payment fund, turning a scary number into a real goal. Fourth, you plan for the hidden costs so there are 0 surprises. And fifth, you get that powerful pre-approval, your green light to hunt with confidence. Buying a home is a marathon. The market is always going to shift. Experts are forecasting that mortgage rates may stabilize in a range from the high 5s to the mid 6 in 2026, which could definitely help with affordability. But your success isn't about perfectly timing the market. It's about being perfectly prepared. By following these steps, you put yourself in control, ready to strike. When you find the right home, you're building a foundation to not just buy a house, but to own it comfortably for years. To make this even easier, I've put together a free downloadable first-time home buyer's financial checklist. It breaks down everything we talked about into a simple to-do list. The link is right in the description below. Listen guys, thank you for watching. If this was helpful, do me a favor and hit that thumbs up and subscribe for more guides on your homeownership journey. And be sure to check out my next video where we'll break down how to find a rock star real estate agent for 2026. You've got this. Now go and get started.